I am very, very excited about this topic. I'm even more excited about the group of panelists that we have here. So I'm going to quickly introduce them and then we'll jump right into it. So first we have Samantha Simpson. So Sam, I know you've worked with lots of companies on building credit models and credit strategies, many of whom are in this room. And I think one thing that's really great about having you on this panel is you've worked with the big banks, you've worked with the fintechs, you've worked with startups and everything in between. So I think you really have a broad and unique perspective on the whole ecosystem. So I'm super excited that you're on our panel. So welcome, Sam.
Thanks for having me.
All right, we have Eric from RBC. So Eric Walker, he just joined RBC recently. He's had a long career at Capital One. He's an expert at developing high-performing teams, advanced analytics, artificial intelligence. Eric, I think RBC is super lucky to have you. And I don't know why you wanted me to say this. Maybe it's because I gave you your first job at a university, but Eric is also celebrating 14 consecutive years since moving out of his parents' basement. So welcome, Eric Walker.
Thank you, thank you.
And last but not least, we have Jason Appel from GoEasy. Jason has over 2 decades of risk management experience in consumer and small business lending. Jason is also chair of the Canadian Lenders Association Risk Roundtable, which I know a lot of you are a part of. And Jason is also the Risk Officer of the Year for the CLA in 2022-2023. So welcome, Jason. So 2-time Risk Officer of the Year. Not 2-time consecutive Risk Officer of the Year. Has that been done before? Where's Gary? Is that the only one?
I think that's the only one.
That's the only one. All right.
So far.
So I wanted to start with cash flow underwriting. So I'm a self-professed credit nerd. I think that cash flow underwriting is one of the most transformative things in consumer lending since the introduction of the credit score. So we know by accessing real-time banking data, we get a much better view into the financial health of our prospective customers, especially those with thin or no credit history. And I know that adoption was slow on this in the early days, but it's really been picking up lately now. We've seen a lot more people start to develop cash flow underwriting strategies so they can build machine learning models and credit rules that incorporate these bank account attributes and then can use that to improve their risk prediction and grow their lending businesses. So maybe start with you, Jason. How have you guys been testing or adopting open banking and cash flow underwriting at GoEasy? And what are the use cases where you're seeing value, maybe both now that you've got in production and then maybe in the future as well?
Sure. Thanks, Brent. And hey, everybody. Go Jays, go. So we've been doing cash flow underwriting at GoEasy now for probably about a half decade, maybe slightly more. And as you would expect, we've found the data that's contained in the customer's bank statements to be very helpful in terms of its predictability of risk because it contains insights that you simply won't find in the credit reports of the customers. No disrespect to my colleagues at Equifax or TransUnion. They have a great product. This is in addition to that great product. So we've been using it for a while. We found it really helpful in identifying, Brent, as you mentioned, sort of what I call new to credit and really bad to credit populations because that data is quite illuminating in its potency. But here's something that you may not have thought about, at least when we look at it from our branch-based model that Patrick talked about earlier. Believe it or not, it's really hard to get people to understand banking data in an underwriting model in terms of explainability. It's actually harder than you think because traditional lenders are more anchored on your credit scores as being the be-all and end-all that what you can explain the customer about. This is a little bit different, and it takes a very delicate touch to be able to educate and inform the frontline lender who we rely on to close most of our transactions in our direct-to-consumer business to make all of that come about. Now, what I will say in answer to the second part of your question is, if you think I get excited about the use of that type of information around the account acquisition side, I actually think the real potent use case is on the account management side, specifically in areas like collections. Again, if you think about where you can get your quickest and fastest tip-off to where your customers may be experiencing some element of duress, there isn't a better indicator than to look at how quickly and abruptly they can absorb and ultimately deplete the sources of income that they have. And that's simply something you just won't find on a credit report on day one. It's not that you can't find it, you can, But getting it out of the banking is really, really powerful. Unfortunately, we're not at the point where we have all of that information available to us. But when that day comes, and I'm hoping it comes soon, that to me will be a game changer. And the way I think it's a game changer is I just see it as another way where you have the ability with that insight to find a way to prioritize the repayment of your customer's debt over that of your competitors. So those are my thoughts.
No, those are great points, Chase. I couldn't agree more. I mean, I think the use cases just continue to move across the customer life cycle. At the start, it was a lot more around account opening, and now people are getting into underwriting. I think next servicing collections is the next place to go for sure. Eric, maybe let's focus on RBC and kind of how the banks are dealing with this. Because when we talk about open banking and cash flow underwriting, sometimes we think of off-us data. Like we think of the fintechs using Flinks to go and get other bank account information. But at RBC, you have more bank data than anyone. So how do you think about integrating, data from wealth, personal banking, some of your other business lines, and getting those into your underwriting decisions? And from the little I know of working with the banks, that should be easy, but I'm guessing there is some challenges to doing that as well. I'd love to hear how you guys are thinking about that.
No, that's a great question, and thanks for the question, Brett. So at RBC, maybe a little bit different than some of the optimization functions that other companies are going for. Safety and soundness in lending is absolutely paramount. So we would be meeting, more frequently than monthly with the regulators, and they really want to make sure that we're doing high quality loans and that clients have a high capacity to be able to pay that back. And so using all of the available data at RBC is just tremendously important to do that. And so you've got the credit bureau data from the bureaus, which is the debt side of the equation. You've got the income side of the equation, and then you have the on us bank data, which is used as the capacity side of the equation. As wonderful as you think my life might be, having broad access to all of those things, it's not always right at your fingertips. And so we spend a ton of time just wrangling the data, which I'm sure folks are familiar with here. And so the grass is not always greener at the other side, and we'll unpack this a little bit with some of the advancements in AI and technology, and certainly that will make it a lot easier. But wrangling the data is, even when you have it, still a big challenge.
Yeah, you bring up capacity. Like in lending, we often talk about willingness to pay and ability to pay, and I think the credit bureau really gives you a peek into their willingness to pay. But the ability to pay is where historically you had to get people to send you pay stubs, proof of income, all of that. And now with digitization, I think we get a much better look into their capacity and ability to pay. It gives you a much more 360-degree view of the consumer, right? Now, Sam, the exact opposite end of the spectrum from RBC, you work with a lot of complete startups where they don't have any historical credit performance. And so arguably, cash flow underwriting, on a relative sense, is even more important to them because they don't have access to historical credit history, and they're often going after thin files or some of these underserved segments. So how do you think about it from a lifestyle perspective of new startups? Like, what do you tell them they should be doing day one, and maybe what should they be doing as they scale up?
Yeah, absolutely. I think about this in two categories. I think we work with a lot of lending startups that are either brand new to lending, and their common problem is that they're going to face costs issues. And then in the second bucket, you have the lenders that are still startups, but they're already using credit bureau data, so they've started, and their biggest problem is going to be kind of that onboarding friction when they bring in cash flow data. And so on day one, if you're in that first bucket of new lenders completely, you're building all your processes up from scratch, you are going to face a decision point, most likely. That decision is going to be, do you go after credit bureau information or cash flow information for your customers? And the reason I say that likely you have this decision point is because when you're first launching, your margins are going to be very thin, if not negative. And so any additional costs that you're bringing in are going to be quite taxing to your unit economics. And so the conversations I often have with startups is that they don't really have the capacity to bring in both providers at the beginning. And so deciding which one to do first will depend on the business that you're doing. It might make sense to do cash flow underwriting if you're, say, in a credit invisible segment and you have no other choice. If not, you might want to opt for credit bureau first and then eventually bring in open banking or cash flow underwriting when either your volume has gone up and that cost per pull has come down from those providers, or your margins are quite healthy, and you can then kind of take on those additional costs. If you're in that second bucket where you are a lender that already exists, but you're currently only using credit bureau information, you want to pull in that cash flow information to build up your data set, get more real-time, diversified information that's orthogonal to what you're getting from the bureaus to really add to your credit models. The problem you're going to face is kind of that onboarding friction. So you're adding an additional step to your onboarding flow, and it's common for us to see 40 to 60% drop-off rate from including this in the onboarding. And so what a lot of lenders will do is to dip their toes into cash flow underwriting. They'll use it as a kind of a flow down state or a second look. And so you would go through your typical credit underwriting. If a customer falls within your marginal segments and you want to see if you can either turn a decline into an approve or potentially offer them better terms, those customers are much more likely to be willing to give you that open banking connection. And so that's a win-win. Although you're still left with the problem of how do you get kind of that data across the board so that you can really optimize your risk models. And so there you really kind of focus on your conversion, build trust with your customers. There might be an educational component there for open banking, depending on where you're playing in the space. But there's definitely a ton of value to be had if you can crack that open.
Excellent, that's great. And just by quick show of hands, how many people here are using cash flow underwriting today or develop solutions on that? Yeah, okay, excellent. So we can't have a topic on data without bringing up AI. And so I know we're all looking to capitalize on AI, but a lot of companies don't know exactly where to start. As we think about it from how AI can transform traditional underwriting models, I think there's broadly two sort of aspects to that. One is automating a bunch of manual steps in the process. And the technology's still good now. It's not just automating, there's some level of judgments being brought into that as well. But a lot of reducing steps that people can do and replacing them with AI. And then there's a second aspect of maybe using AI to build more predictive risk models. So maybe I'll start with you, Sam. As you think about those two aspects, like with the clients that you work with, like what guidance do you give them on where to start first, and where are maybe some of the implementation considerations or pitfalls you tell them to avoid?
Yeah, my answer might be quite simple here, but I think it's quite important to make sure that you're applying AI to an actual problem in your business. I think we often see that there's sometimes a top-down request to have an AI functionality just for the sake of saying you have an AI functionality that may or may not be actually solving a problem. I think a way culturally to help with this is to have your employees really bought into AI, keep them on top of what the new technology is bringing because it's constantly changing, and then they are more on the ground and able to provide kind of bottom-up solutions to real problems that they're facing. I think we can all learn from Klarna that tried to replace 700 human agents with AI and then immediately had to roll it back a couple of months later. So a few things I learned from that. One, you should test before rolling out. And then two is if you're just starting, maybe starting somewhere in the back end first before rolling something out customer facing. And so within kind of lending, we often see that in really heavily manual, as you mentioned, kind of unstructured, high potential ROA processes, which often is document extraction or document capture. So if you think of a small and medium-sized business lender, they're going to accumulate tons of documentation on a company, and then typically you have a manual underwriter going through all that information, picking out the one that's important, and then kind of underwriting and making that decision. AI can take care of all of that, and they can bring in some of that judgment, but then you still have that human element of checking or not, the underwriters just spending their time on underwriting. So I think that's a typical entry point, and it's kind of not customer facing, so you're not the next Klarna. And then on the flip side for the underwriting, I would just prompt everyone to think about the tools that are artificial intelligence without being generative. And so there are machine learning models out there that are well used, broadly used. The regulators are used to them. They've been around for a decade, and it is artificial intelligence. It's just not generative. And so if you have the data set to do it, start looking at just adopting a machine learning model for your proprietary credit risks.
Yeah, excellent. Jason, how have you been thinking about these two aspects at GoEasy? I mean, I know your traditional branch model, I'm sure there's lots of opportunity for automation there. And then also on the second one, on you think about next gen credit modeling, how do you balance kind of the potency of the data with sort of explainability?
Yeah, maybe I'll take them in reverse order. So like for all you modeling nerds out there, I think on a good day, it's often hard to build explainability into your credit model, even when you're not using even cash flow. So I think that's a challenge we and many other lenders in the space, whether you're prime or non-prime, are dealing with. We try to build in what we call risk factors. So those are the elements of our model variables that are clear enough that you can explain them. The challenge you have to be wary of is, and again, model builders would know what I'm talking about, is often when you're binning your variables, they don't sign and predict in the ways that you may have thought to be intuitive. Can you imagine trying to explain that to a customer, let alone your staff, and then how to translate that back? So not every element or every aspect of every model ought to or should be explained, notwithstanding the desire for it to be explained. And I think it's about finding a rightful balance to give the customer and the employee, if they're involved, enough information to speak intelligently about it, but not to provide them with all of the keys to the kingdom, because quite frankly, they're not going to open up all the doors. On your first question, we've been, as I said before, we've been doing a lot with cash flow underwriting now for quite a while. We are in the process now of building out, and I'm glad Sam brought it up, it's not certainly a generative tool, but it is more of a model tool where we will now serve up a summary form of banking information that we're capturing and allowing our users, in this case our staff, and in some case the consumer, to then cherry pick those elements that we think are appropriate, streamline the underwriting process, and see if in fact if those attributes are predictive of any outcome. Again, like Sam mentioned, that's a walk versus run approach. And I think the way we've looked at it is before we get to a point where we intuitively take underwriting out of a human hand, let's make sure that when we're even able to serve up globs of it in a straightforward manner, that we actually believe that people can interpret that data and use that data in a way that can be informative. And I think through that learning journey, we will get to a point where you will not need a human in the loop. And if you do, it will be more the exception than the rule. But I would just point out that's an automation opportunity. Right. That is not an AI opportunity on day one. It can get there, but I would just encourage people to think about walking first before they run.
And on the implementation, Jason, any hiccups you had or anything that worked better than you thought, like on the...
I would just say, because we're just in the throes of doing it now, is be very clear about what you want people to do with that information when you present it. How it looks, how it's served up, how you interpret the use of that information. There's a million different ways from Sunday that you can put that stuff out there. Try it simple first. Don't try and overcomplicate it, because, like I said, there's plenty of data there. You actually really want to distill it down to the basics.
That makes total sense. Eric, how about at RBC? I mean, it's been almost 10 years since RBC formed Borealis, so that's your internal AI institute that's doing multiple use cases across the bank. Which ones are you guys most excited about the bank? Either ones you've implemented or ones that you think will be revolutionary in the future for your customers?
Yeah, one of the best parts about joining is getting to experience maybe on year 10 the journey, but for the first time. And so not that I expected it not to be just a wonderfully talented team, but they really, really blew me away around how advanced they were, not just on the analytics side of things, but on the infrastructure, how long they've been on the journey, the cohesive way they're thinking about it, and how integrated it is to the strategy. And so fortunately, they've actually published some papers on this, so I can speak about it at this conference, but they've developed this foundational model called ADAM. And really, ADAM gets at the core of trying to collect all of the on-us transaction data that RBC has. And just imagine, 15 million clients times all the transactions, times all the days that they're making the transactions, like just to collect and process that data.
Is this ADAM, like ATOM, or ADAM like in the garden?
ATOM, not
okay.
not
okay,
Adam,
all right,
not the person, but the foundational element that you build things from. And so the power of that is twofold. One, just the ability to process and make sense of all that data. And then two, do it in a way that not just credit risk models can pick it up, but other parts of your client experience can pick up ADAM. And so such a wonderfully talented team. And they're just not, they came at it because they're not from credit risk, which a totally different perspective. And so when you blend that with people with a deep credit modeling background and a deep AI background, it's actually even more powerful than you've just came at it from a credit risk perspective.
Oh, that's really interesting insight. I can see that. Excellent. Let's switch a little bit. I'm going to stick with you, Eric, for this first question, but switch a bit to build versus buy. So when companies think about transforming their credit modeling with new data and technology, that's one of their first questions is, do I build it or do I buy it? And often the answer is, a combination of both, right? And I know, Hamid, you had this question come up in your session, which I loved. and might get some really interesting insights on that. I think this is something we get asked by our clients all the time, this whole build versus buy thing. So Eric, when I think about the banks, you've seen a few different models here in Canada. So like we talked about, RBC built it from the ground up with Borealis. I mean, TD bought Layer 6 and then kind of integrated them in-house, and they've sort of merged them in with the bank. And then you've got other banks that have more relied on partners or outside vendors. So when you think about the bigger banks, how do you think they should be thinking through the build versus buy decision?
Yeah, the way I would think about it is 10 years from now, what's the world that you want to be living in? And so the world, as we think about it in the Borealis situation is, and RBC has publicly stated that they're very invested in AI. They think it can really be a step change for the bank in terms of the capabilities it can bring. And so if you believe those things and you have the financial ability to invest in it, like would you want your core part of your strategy to be something that you're dependent on partners for? Or do you want to be owning that and developing it and harnessing that and connecting it? And so certainly not everyone would necessarily want to or make that choice, but when we're thinking about that, we're thinking about 10 years from now, what's the investment you wish you would have made 10 years ago? And that's certainly going on the build journey.
Okay, great. So going from the big banks, maybe more medium-sized, Jason, like same question for you. How do you think about the build versus buy decision at goeasy?
Yeah, I think Eric makes a really good point. I think it ultimately comes down to a bunch of factors, but the one I would put at the forefront is probably where does that capability fit within your core business strategy? So I like the analogy, Eric, that you put out there is like, do you want to think of this as something that's core to your DNA 10 years or even 2 years from now? And I'd say, in our case, it's yes. I mean, that is part of what makes the sauce secret, so to speak. So I would say we would tend to focus that ability in-house, provided that you have a high degree of confidence in your staff and their competency to be able to progress down that path. Now, I will add one caveat, because nothing is ever absolute in this world, and that would be, I think you have to balance the need to go outside versus inside. And two things that sort of factor into my thought process is this idea of, do you want to prioritize results over learning? Results over learning. That doesn't necessarily mean every time you venture into this space, you're going to be successful. And I would tell you that if your appetite is to learn more first and make more money second, then the decision to go out or in is easier. You can do both, or you could do one or not the other. But I think that, along with the degree of customization and control that you want to have over the process, are sort of two ways in which I think about whether or not you can be comfortable exporting or outsourcing that functionality out of your business, because you are now relying upon a third party to help you. And by the way, that third party can give that business or parts of it to another of your competitors, and you have to evaluate how comfortable you are with that potential outcome. The only other third part I would add to that is you have to, and I know this sounds overkill, you have to figure out where this fits in your investment thesis as a company. And that is, for every dollar that you invest in this core competency, if this is indeed a core competency, what's your payback threshold? Are you looking to make money in 6 months, a year? If so, how much? Is that going to rise to the top of your priorities in terms of return? Or are you willing to let the learning journey be your sort of modus operandi to guide you on how you want to think about evolving the capability? And I think that it's very clear that you should have those conversations as part of the build versus buy discussion, because they may actually shed some real practical light on what you can and cannot do.
Yeah, you raise a really good point in the learning thing, though. Sometimes people are just looking for like a nail, like a nail to hit, or a hammer to hit with a nail or whatever, rather than the learning aspect of it. I think it's super important. Sam, you work with a lot of startups. You work on a lot of 0 to 1 projects, whether that's large retailers building new lending businesses, getting into embedded finances, or pure startups. So for them, it's probably a little bit different when you're in your infancy. So how do you kind of consult them on the build versus buy decision?
Yeah, absolutely. And it really depends on the size of the company and the resources at hand. But assuming you are quite small and starting off, then obviously building is just going to be out of reach. Like not only just the initial investment, but then the upkeep of whatever you're building. And so typically buying is the first entry point, or really hack solutions like using Excel sheets as your LOS. But essentially, as you start to scale, then it becomes the question that these two were bringing up, which is what is your core competency? Where do you want that competitive advantage? And those are the areas where you should start building or bringing in-house. So, an area where people typically don't bring in-house is collections, as an example. That tends to be something that people keep external, given that it's a completely different business. You would have huge upfront investment, especially if you want Canadian labor, although AI might be changing that. But it's typically not something that people will bring in-house off the get-go, because it's not where you're actually trying to compete and differentiate yourself. But one area where we do recommend all our clients do as soon as possible, and I touched on this in a previous answer, is to bring in your credit proprietary risk models. And so I can't stress this enough, your own proprietary data will be way more powerful than a generic score that you buy from the bureaus or from open banking, because it is data about your customer on your product within your pool and your credit policy. And so making sure that you can bring that in-house as soon as you can. So let's say that you launched using kind of expert rules or simple segmentation based using an external score. Once you get to around a loan book of 5,000 accounts, you should be looking at like a simple regression model, and then building on that as you scale your business. When you reach to around 25,000, 50,000 loans, you can start looking at machine learning models, and really that will be like a step change for your underwriting. Gary, you bringing us wine, or you just?
Yeah, instead of like the flashing thing, Gary just brings a glass of wine. I think that means. Anyways, finish your answer.
Yeah. So, anyways, bringing machine learning risk models in should be the first place where you're thinking about building in-house, and then all the other pieces. And I think Jason touched on this as well. Like, are you trying to learn, or are you trying to differentiate yourself in an area where providers can't or aren't touching on a specific tool that you need, like in a loan origination or in a loan management software? But that's typically a little bit further down the line when you're quite established, where you want to bring in some of those pieces. Maybe a lot of the big banks that we work with still use providers for those pieces, so it's not a necessity for you to bring that in-house.
Absolutely. So last question, and it's going to be the same question for all of you. We'll start with Jason at the end there. What are you most excited about in the future? So what do you think is going to be the biggest game changer in underwriting? Jason?
Well, I've had this question posed to me before, and the traditional answer I used to give is I would always value more data over better modeling, right? I would always put that as priority one. And I remember when I got first asked that, when everyone was a flutter about social media data and how we need to build them all into the credit models. Well, that didn't exactly go the way people had anticipated. And then if I think about where we've evolved over the last 10 years, I'd say my answer has morphed a little bit. I'm actually really intrigued and excited about new modeling techniques. And by modeling, I don't necessarily mean like a more exotic model or a gradient boosted model or ensemble models, pick your poison. I just mean this ability to bring in these disparate data sources, tie them all together, and see if they can tell a very predictive story that the way in which we've been looking at customers today is different, better, new, exciting, fun. And I would say, I feel that we're on the precipice of getting closer to that, partly because more data is becoming available, and I think also because, quite frankly, people are getting smarter on how they work with lots of data. Yep. And they're much more willing, I think, I can only speak for our companies, is to test their way into it and screw up along the way if that's part of the formula. It's the ability to fall forward, not backward, that I think will differentiate the good lenders from the bad lenders. So what I'm really excited about more generically now is that I sense a tide change where people are now more willing to fall on that sword, knowing that they can still get up from it if it doesn't yield them exactly what they thought, but the learning will be of a great value.
I love that. Fail fast. Yeah, great.
Fail fast and fail often.
That's right. Thank you, Jason. Eric?
The thing that I'm most excited about, so if I fast forward back to the beginning of my career, it felt like you could imagine things, but the technological limitations or the costs were so prohibitive. And so you could just imagine more than it was like technologically achievable to do. And then the innovation that's happening, we're talking about LLMs, we're talking about data processing, compute, the ability to do those at scale and on demand at price points that 10 years ago, you just couldn't imagine when you're getting those in-house tech bills. And so when you think about all those as ingredients, it's almost like I'm now not able to imagine all the things that these things are capable of. And so it's almost like the reverse of a problem. And so when the tech constraint is removed, what are we capable of doing in this space? And so I'm really excited, 5 and 10 years down the road to think about, well, what were all the things I didn't even imagine today because I was just so limited by like the physical constraints around me. Just feels like all those physical limitations and constraints are no longer going to be there anymore. And now I'm worried, have I imagined a big enough and grand enough vision for the future? And so really excited to find out what that future is.
You're thinking back to when we used to visit TransUnion, their on-prem servers in the bunker, and just imagining like today, right? That would, yeah. How about you, Sam?
I think my answer is Jason's old answer. But I think with all of the companies that we work with, what I think will be most game changer for them is organization and usability of their internal data. I think for a lot of the companies we work with, that will be the biggest step change in their ability to then do all the tooling, stitch together all the data sets, be able to use, AI and anything else that comes along, is organizing your internal data first.
Amazing. We got 23 seconds left, so that's just enough time to thank Gary and thank all of you and thank our great panelists. It's been a wonderful day and hope to see everybody at the cocktail reception. Thank you.